please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Yes, that will be, you know, what in Sanskrit you say, Vishwamitra called me a Brahma Rishi. You know, anyone calling me a Brahma Rishi is not good enough. Vishwamitra is the sage of sages, and he has to say. So this is what my parents would usually say. You have to get the upgrade from the one who is respected more. But you know, I'll tell you the other thing about rating agencies. They usually follow the market. The market was always giving Indian bonds a rating, a yield level which was higher, or rather the yield level is lower than what the rating implied. Other similar Baa3 guys wouldn't get as good a bond yield as we would get anyway, because the market had realized that the fundamentals are coming in place. So in a way, Moody's also is recognizing a market reality, but more in terms of what it means. It's very good news for the rupee, very good news for equities. For bonds, we were, you know, already the FI limits are reached. So immediately you will not be able to see too much of a rush of money. But then I think we have actually, it's a big day with a lot of big voices joining in to gauge the implications of the rating upgrade. First up will be the man in the driver's seat, William Foster of Moody's Investors Service. He's joined us already. Okay, Mr. Foster, good morning. Thank you very much for joining us. Just wanted to know first, what is it that qualified India to the upgrade?
Well, you know, Moody's first put India's credit rating on a positive outlook in April 2015. So that was the first expression of the possibility that an upgrade was on the horizon. But since then, in November 2016, we decided to maintain the rating at Baa3 and maintain that outlook. And the decision at that point was based on the fact that while the reforms that were moving forward were certainly promising, we weren't seeing enough clear evidence within the real economy and broadly with regard to just the overall impact across the credit profile, that these reforms were ultimately going to result in the true kind of effectiveness that one would hope. And so we needed a bit more time to get greater clarity, build greater confidence that indeed over time the economic and institutional changes that the government was putting forward through these reforms would actually materialize on the ground. And our decision this week was to go ahead with the upgrade, because we believe at this stage, after a year since our last review, that we have seen sufficient evidence to give us greater confidence that these reforms ultimately will result in a higher level of sustainable growth moving forward, that will create an environment for greater competitiveness and a kind of robust economic outlook, despite the challenges right now with GST implementation, for example, and obviously following demonetization. We see these as short-term disruptions, but laying the foundation for what will be higher sustainable growth in the future that will ultimately contribute, in addition to the fiscal reforms that will be pushed forward on the revenue and expenditure side, to, over time, the ability to address this high debt burden that is the weakness in the credit profile. We believe that ultimately the debt burden will not come down quickly over time, but it will be sustained at the similar level and then slowly, gradually come down as the economy picks back up in terms of the higher nominal GDP growth, and the investment cycle eventually starts to turn.
Okay, William, good morning. So, do you expect the investment cycle to turn up? You know, we have ratings upgrade now. Also, the ease of doing business rankings, India has been improving. So, over the 1 or 2 years, is that your base case that the investment cycle will pick up?
Well, you know, it's been quite frustrating. Obviously, capital expenditure has been declining for years, despite you know, the efforts that the government's put forward with trying to improve the overall business climate. So those scores and the improvements that you saw, I guess, just a few weeks ago with regard to the doing business indicators and general surveys across a few years, they have been improving, but you haven't actually seen it on the ground in terms of the actual data coming out with regard to investment. And that really is, from our perspective, a byproduct of the twin balance sheet issue that you have going on in the economy with high leverage for corporates, and then obviously all the MPAs on the balance sheets for public sector banks in particular. So, you know, this is going to take time. Ultimately, you know, our view is that the government's proactive approach to trying to address the issues in the banking system, obviously they've been pushing forward with a framework for resolution, but now with the recent announcement for comprehensive capitalization for the banks. That's a good starting point. And then, in addition to the measures that they've been putting forward to try to attract investment and to try to build a better framework ultimately for an operating environment for business, should help. And then, of course, GST. We see the true benefits of that ultimately being realized through the kind of the simplification of the tax structure for businesses across states and providing a framework for businesses to have a national business strategy, not just a more fragmented state-by-state strategy. So all of this, will take time, and obviously there's issues in the near term in terms of having to work these things out. Its implementation is slower in India than you may see in other places, and overall it's a bit challenging. But we believe that these issues, for example, with GST and the supply chain, will work itself out over the next few quarters. We believe that the banking system will start to work out these issues, although it will take time. And ultimately, these are the things that need to happen for the investment cycle to turn. But it's, we're not expecting that to happen any time in the immediate future, William, but we believe it will happen over time.
Yeah, William, what is the pecking order for a rating agency? Were you all impressed first by our fiscal deficit, by the tax reform, by the bankruptcy code, by the bank cleanup? What is your pecking order? And if the tax to GDP ratio were to indeed improve, are we in for a further upgrade?
So that's a great question, and the real answer is it's not one thing at all. It's the culmination or the combination of the various reforms together, working together to strengthen the credit profile across the spectrums that we look at. Obviously, the weakest link for India is the fiscal side of things. So the very high level of debt relative to the peer group. So you've heard this before, I'm sure. We mentioned that the debt to GDP ratio for India is about 69%, and the peer group median is 44%. So it really stands out in terms of how much of a debt burden it has to work down over time. So even if these, for example, you mentioned tax to GDP, that's very important for India because ultimately that's the basis for financing infrastructure investment and other things that are going to contribute to the economy.
Also bring down the debt.
And it'll bring down the debt. But what you see with India in particular is that in the past, at least, what's really brought down the debt for India is high nominal GDP growth. You saw that prior to the great global financial crisis, when it was over 80, it was that high level of nominal GDP growth that really contributed to that bringing down the debt stock. But a prudent fiscal framework, medium-term fiscal framework, and bringing down those deficits over time will obviously contribute as well.
Okay, William. Final question from my end: is there a global risk to this call, especially crude oil? Because we have seen quite a bit of move from the lower levels. If we start to see a move, say above 70, could that put this thesis at risk?
So this is something we're watching, obviously, and India is vulnerable to sharp prices in oil. Going up. Obviously, it benefited tremendously from the decline in oil prices, and the current account closed, very significantly from 5% of GDP during the taper tantrum to below 1% this past year. We expect it to be closer to 1.6, maybe even closer to 2% this year, but we don't expect it ultimately to result in significant external vulnerabilities widening or exceeding what the capacity of India has to absorb. But of course, India is sensitive to those higher oil prices, and that's something that we'll continue to watch.
All right. William Foster, it was a pleasure speaking with you. Thank you very much. You are the harbinger of very good news for the country. Thank you very much for joining us.